once again, you're all very, very welcome to join us. If you're joining us here through the YouTube live stream, that's fantastic. It's great to have you here. If you enjoy what we're having to say, don't be afraid to give us a like. If you've got any particular questions or comments, whether you're here in the room on Zoom or whether you're actually joining us on the YouTube live stream, then by all means, as I said, give us a like, subscribe to our channel to get all the latest and best information, and also, as I said, drop in some comments if you've got any particular thoughts or queries or questions, or even if you've got particular ideas for future topics that you'd like to see us to cover. We're always really fascinated to get that feedback from our clients and viewers, and we always take that on board when we're looking at our future topics to cover in this webinar. So today, what we're going to talk about when I switch across to the charts in a few moments is, what can we learn from this whole GameStop trading event that we have seen running, and it's still running during the early part of 2021. Fascinated to hear, whether you have, whether you are have been part of that, whether you are an investor or a trader in GameStop, or whether it's it's completely new information and news to you. I always appreciate that we have a real wide range of people joining us here today, from complete beginners to people with lots of significant trading experience. So, if you've got your own thoughts, your own views, your own particular opinions, please, by all means, pop them in the chat box and the commentary box. It'd be fantastic to hear what your own experience has been, and I'll be happy to sort of take that on board as we go through our conversation this afternoon. So without further ado, if my wonderful assistant has given me control, what we'll do is we'll switch across the charts, and then we'll charts on the PowerPoint slides, and we'll actually have a talk about what can we learn from the GameStop phenomenon. So just bear with us a moment, ladies and gentlemen. Hopefully, should be able to do this, he says, and. Boom. I'm hoping that you can still hear me. I'm hoping you can actually still see me as well. It should be there. Like just as I say, always just let us know if you can. That's great, and welcome to today's main topic. What can we learn from GameStop, all right? And what lessons can we take from the Reddit or Wall Street Bets event that we saw, at the end of January? But actually, as we'll look at the charts later, it is still ongoing for us. It's been quite a fascinating event, and I appreciate, as always, that regardless of what your trading experience is, regardless of your own particular style of trading, there is always something that we can learn from it, all traders, and that's what we're going to be talking about. We'll talk about what happened to give you a little bit of background, but also what are the lessons that we could learn? Who were the winners and losers from this particular event? What could we actually learn from that to take into our own trading? Regardless of what type of trader you are, regardless of what particular asset class you may look to trade in, there are always great lessons that we can take on board. So, as I mentioned earlier, as part of Admiral Markets' 20th anniversary, they will be rebranding to Admirals, as it says there, as they venture into a new era. It actually will have no real impact upon you as existing clients. It's just effectively it's a particular rebranding. But we hope you like it. If you've got any feedback or any thoughts in it, by all means stick it into the chat box, or by all means drop us a note, and it will be great to hear what particular thoughts you have. Hi Sergey, it's great to have you here, and hello Peter, as always. Thanks for the feedback. They're always great to have you here for our Admirals Trading Spotlight sessions. And as Admirals and are they are particularly a global brokerage, with local support. They are licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products, allowing the opportunity to engage with markets using both the MT4, the MT5, and also the own Admirals Supreme Edition platforms. If you have any particular questions about Admirals, please get in touch with your account representative, and they'll be very happy to help and guide you. So what are we going to talk about today? Well, we're going to talk about how GameStop became a market mover. How did it come out of nowhere to be almost like the sole focus of the trading community for a few days towards the end of January 2021? How did that come around? And what were the repercussions for traders and the markets? Were there, were there particular elements that were widely accepted and embraced by traders, or were there actually elements of it not particularly liked at all by traders in the community? As I said, some of you may have had experience of either trading that. Some of you may already still be engaged and involved with it. And as I said, please, we're great to hear your thoughts and comments on that. But most importantly, what we want to focus is, what can traders learn from that trading event? Okay, there's always something to take away. There's always something to learn. Even, for someone like myself who's got experience in trading, there is always something to be able to take away and learn from in our own trading. Okay, you're never there as a trader. You're always You're always sort of learning and growing and evolving as a trader. There's always something we can take on board from that. For me, for those who don't know me, my name's Paul. I've traded for many years, traded for hedge funds and for high net worth clients. Okay, primarily my own particular focus is trading FX indices and commodities, but although I will engage in things like equities and cryptos, etc. Primarily my own style of trading is to be a trend trader for longer term positions, and then a reversal and mean reversion trader for shorter term intraday trading. So, what can we learn from GameStop? What is the thing that keeps us kind of, enthused, what was it that made this such a fascinating opportunity for us to focus on just a few weeks ago? And as the slide says, it's one of the major early trading events of 2021 as being the sudden emergence of moves made in certain stocks. Okay. And, we had a rather volatile 2020, right, for various reasons, which, I'm sure you're well aware of, ladies and gentlemen. But, one of the questions was 2021 going to be a quieter year, or was it actually going to be even more volatile? Well, we're into the third month of it already, okay, and it might be said that, we've had some, unbelievable volatility across a whole wide range of asset classes. And one of them was, towards the end of January, we saw some real volatility in certain particular stocks. And what happened was, these moves were, let's say, were initiated and orchestrated by certain groups on social media, which then generated a load of exposure, a load of interest, a load of focus, a lot of trading. And really, what we want to look at is, well, what actually happened there? What was the outcomes from that? Okay, what were the repercussions? Who were the winners? Who were the losers? What actually sort of came about that? And today we'll discuss the event and see what traders can learn from this overall experience. So, if you have followed this yourself, if you've been shown an interest in it, well, is it a case of, what did you learn from the experience? Maybe you could share that with us. It's always fantastic, I think, to be able to help share that with people. Maybe, you have your own particular views. Were things done right? Was actually things done wrong? What were your particular views? Okay. Or maybe you know nothing about it, in which case, you want to learn more about it. That's absolutely fine. That's no problem at all. That's part of the reason for these sessions, is to be able to help enable and teach people about them. So, where should we start, ladies and gentlemen? What is the story? What actually happened and occurred, and what's gone on here? Okay, and I'm going to give you a rather kind of big picture view of it. Okay, there's specific certain details here that we could go into it, but we don't have all week really to go about it. We've only got our sort of 30-40 minutes here today, but what we found was that, let's look at a company called GameStop. Now, GameStop is as the picture implies, the bottom of the screen there, GameStop was a bricks and mortar retailer, okay, which primarily seemed to be the focus of selling lots of products that would appeal to teenage boys and perhaps other boys who've not grown up yet. Okay, so it's primarily a kind of an advanced toy shop of one sort or another. And not unsurprisingly, okay, they had been struggling for a while, okay, because of the switch to online retailing, which we have covered before in quite a few of the Admirals Trading Spotlight previous webinars, which you can find in the archive. But invariably, they were struggling as a company. Okay, they weren't doing terribly well, even though they had a very loyal customer base. Okay, but invariably, they were struggling just because of the particular retail environment we find ourselves in there. with that, what we found is that they were, of course, they are the ticker GME. Okay, they were a company on the floated on the stock markets, and because of their particular issues, because of their particular problems, because they were deemed to be, the likelihood of being a failed company. Well, what we saw was that there were particular institutions took a great pleasure in shorting GameStop stock. Okay, they were actually selling into the stock. One of them was a hedge fund called Melvin Capital, and they weren't alone. You may have heard this name around it, but they weren't. They weren't the only, but they're one of the major sort of short companies, and also one of the kind of repercussions which we'll touch upon in a short while. So what we saw was that, as I said, GameStop was being shorted primarily by hedge funds, but also just normal institutions. And what became apparent was that, in fact, they were actually shorting more stocks than were actually out there. Okay, it was oversubscribed on the short side for these hedge funds and other institutions that were trying to short GameStop and trying to sort of depress the price. What happened there as part of that is that, on a particular sort of news aggregator website, Reddit, many of you might well use it. There was one particular area there, or one particular group on there called Wall Street Bets, who effectively, what they were doing is, they are a community that's created around quite a few very passionate and involved traders, who invariably were always looking for fantastic opportunities. Okay, and what they became aware of was the fact that in GameStop and a few other companies, that in fact, these hedge funds were effectively overextended. They were effectively, they were oversubscribed on the short side. Okay, it was a crowded trade into companies like GameStop. Lots of those people who had been were on Reddit, sort of looking on Wall Street Bets as traders, had been those teenage boys who would spend their hard-earned pocket money and weekends in GameStop. Okay, and so they had a particular fondness and allegiance to it. And what they felt was that this was an opportunity for them to effectively strike back at Wall Street, to strike back at the big guy. And they thought by actually clubbing together and buying GameStop shares, well, invariably what that would do is that would actually sort of drive the share price up. And what would happen is that would cause the likes of Melvin Capital and the likes of other hedge funds the need to actually cover their shorts, okay, because effectively they would be taking losses. And by covering their shorts, well, then invariably they felt as if they would be they'd be striking a blow for the small guy, but also that actually they would actually make some profits in terms of actually rising the price of GameStop. And this is what actually happened. This is what occurred, and this is where they clubbed together, started to buy into GameStop. But as I said, on both sides of this, I'm going to touch on this a bit more. It wasn't just this kind of David and Goliath, on the sort of Wall Street Bets, the small, individual retail traders up against the hedge funds and institutions. The picture is a little bit more opaque than that. And what became apparent was actually what happened over the few days of the sort of, really media frenzy about the sort of phenomenon that was going on. Because what we saw was GameStop stock was actually starting to rise. Lots of those people from Wall Street Bets, lots of those retail traders, lots of those kind of social media traders following this story on whatever form of social media, they were actually jumping on board and following this thing, and actually they were trading through brokers like Robinhood. Now Robinhood sort of effectively it's basically it pushed itself as effectively a kind of a free trading app. No commissions, no trading costs, commissions. Okay, so effectively that appealed to people who, let's be face it, have been stuck at home during lockdown. They've not been able to go to sports games, not been able to get out, to go about. So actually there was lots of people with a little bit of time on their hands, and some people with a little bit of money from their stimulus checks within the year in the US, given to them by Mr. Trump, that invariably put that stimulus money into the likes of apps on Robinhood and started to trade GameStop. But here's where the picture starts to become a little bit more interesting, because the reason that Robinhood was able to offer commission-free trading to their clients was what actually turned out to be was that most of the data, their trading data, was being sold to a larger hedge fund, an absolute colossal fund by the name of Citadel, and that information was used by Citadel to basically for their own particular trading decisions. But what actually occurred was that Citadel were also one of the biggest investors in Melvin Capital, and they weren't terribly pleased to see their investment in Melvin Capital being destroyed by the sort of rise in the GameStop price being fueled by the retail traders on Wall Street bets. So, very quickly, what we saw over a very short period of time, maybe 1 or 2 days, was that suddenly, trading on GameStop and a couple of the other particular stocks, which we'll look at in a moment, was curtailed pretty much quickly, more or less overnight. Whereas, in fact, brokers like Robinhood and other brokers stopped their trading in GameStop and other particular stocks. This basically allowed Melvin to effectively sort of get a grip on their particular losses, which I think ranged to around about $12 billion. Might even be more, might be less, but certainly a not an insignificant sum, and also which of course basically allowed Citadel to effectively get into to sorting out their own particular positions. What that did was, it actually, it helped those hedge funds, which of course just kind of fueled the, let's say, the angst of, the Wall Street bets crowd and many retail traders feeling that what happened is we had seen market manipulation, but not, market manipulation to effectively to help the kind of, let's say, the major established hedge funds, rather than looking out for the sort of average Joe in the street, which only fueled more ire. And because of that trading stop, well, what we saw was actually the share price, drop rapidly, and that's where we were until a few days ago. So as I said, it's a rather, it's a fascinating story, and there are elements of it that perhaps might seem a little bit opaque. There's invariably it attracts the interest of people like conspiracy theorists, etc. Not unsurprisingly, but invariably what we saw was a real kind of almost kind of a pump and dump situation that happened very, very quickly over a very short space of time, and we'll look at that a little bit. We'll look at that a little bit more now. So, this is the chart of GameStop. And this is a daily chart of GameStop, okay? And, this quite sort of gives us a little bit of an indication of the kind of frenzy that occurred, that actually what we saw happening during that particular period. And what you can see, as I said, on the daily chart, well, invariably what we saw was that, for the vast majority of time, GameStop really kind of knocked about between about $10 and $20 a share. Okay, that was really having it been depressed so much, it basically it was just knocking around in a range between $10 to $20 a share. Okay, and there were quite a few buyers, and one of which we're going to touch on particularly later. But what you can see is that as we entered into sort of January 2021, is that actually we broke out of that range, and actually suddenly GameStop is effectively it's trading up towards kind of above 40, between $40 to $50. So if you've bought at $10 and you're now trading at $40 to $50, that's a handsome return. You'll be very pleased. If you're Melvin Capital and other hedge funds who have effectively been shorting massively, expecting the price to drop, beneath 10, down to 5, down to $1, $2, you now are in a particular, you're in quite a pickle, okay? Because you're in there, you're going to be getting margin calls. You're going to have all sorts, of serious damage to the P&L of your account. So invariably, what we saw is that, is what happened is that as those hedge funds started to actually cover their shorts. So remember what happens, and if you have a short position, you have to cover it. Well, actually, what that means is you have to flip. So you now flip from being a short in the market to being a buyer. So you've already got buyers adding to the buyers. So it's just effectively pouring oil on the fire, and that's what we saw, is that we saw price starting to actually sort of rocket up, and it actually started to go vertical, and we started to see price going through $50, $60, $70, $80, $90, $100, as you can see for yourself there. And then, of course, what happens is, as this occurs, and because of the impact of social media, well, invariably, it just like it attracts a crowd of traders from big institutions like banks to hedge funds, okay, to prop shops, to actual private individuals, and that's what we and this is what we saw, and so we saw over a weekend of people being really excited, where basically the price opened at or closed around about $160. Well, then, what we saw on the Sunday night, on the Monday, is, we saw price actually jump, significantly. Price jumped massively, okay, until we were up there, up there about, about 300, I think it was about $343, an absolutely massive jump in price, okay, a massive gap in price, and of course, this then just starts to cause alarm bells. If you're short, okay, in GameStop, this is causing all sorts of problems. Hence why we saw the interventions that we did. But equally, what it also did is having that weekend meant that basically people who, let's say, were not traders from the first day, never real traders beforehand, who had just seen this and just thought that this was a bandwagon they could jump on, were effectively putting money into brokers and trying to buy at whatever price they could get filled. So suddenly you've got people getting filled at $300, $310, $320, $330, $340 for a share. The next day was quite traumatic, because what we saw was price launch itself up there, okay, and it tickled the soft underbelly of $500. It was up to about $480 before we started to get in the trading freezes in terms of stopping trading on GameStop, which then basically saw the price absolutely collapse and plummet. And so, almost in one day, from having been almost up near $500 a share, we went down to closing at I think it was just under $200 a share. Then we started to see, invariably, quite a bit of angst being shown, both, across all forms of media, about how basically markets were being manipulated to effectively for the benefit of hedge funds, as opposed to for the main guys, or for actual just main people operate in the markets. And then what we saw was, we saw actually quite a few panics there, okay, in terms of price. And so what we saw really was just this, over a couple of days, we saw a huge range in prices from $120 up to $480 a share. Okay, there's just absolute, pandemonium volatility there in the market, which is, and this is the thing about volatility, it's a double-edged sword. Okay, when you're on the right side of it, it's fantastic. When you're on the wrong side of it, it can be enormously painful, both financially and emotionally. Okay, and there will have been an awful lot of people who are on the right side of this, but also a lot of people who are on the wrong side of this, and we're going to talk about that in a particular moment. But hopefully, what you can see is you can just see the kind of the dynamic of how effectively that share price just operated literally over what was just almost like a 10-day period of just what became absolute madness. And I always recommend, there's a great book written by a Scottish chap, I think it's called Charles White Mackay, okay, who wrote a book called the sort of the madness of crowds. And this was a book a couple of hundred years ago, but actually it is still it's still absolutely apt today, simply because humans haven't changed much. We have fantastic technology that allows us to do unbelievable things, but it also gives us maybe a little bit of a sense of infallibility, okay, that we can't be wrong, okay, that we are smarter than our ancestors, and in many ways we are, but in many ways we are still the same. We're not too far from cavemen, as much as we like to think we are, as much as we like to think we're not. And that delves deeper into the psychology of trading, which is something that my colleagues Marcus and Jens have done numerous webinars on in the Trading Spotlight webinar archive, which you can find there on our YouTube channel. And what we saw was, even though the focus, both in terms of the trading and the media, was based on GameStop, there were actually also another couple of stocks that were of interest to let's say the Wall Street Bets group. One of them was AMC Entertainment, a ticker AMC, the kind of cinemas. And you can see for yourself, okay, that before this kind of phenomena, sort of trading events kicked in, you can see there, the share price was there really sort of just banging about between about $2 and $8. Okay, you can see for yourself. And then what happened was that we had that whole GameStop phenomenon, and you can see how the share price actually sort of just went wild. went wild there over a couple of days. And once again, from having been, sort of sitting around here, okay, under $3, well, suddenly within just over a week, we're opening, okay, we're opening at $20, okay, and which, of course, if you've bought at $3 and you see your share opening at $20, well, then, well done to you. You're very happy, you're very pleased. The other issue is that if you have missed this and they're getting filled at $20, you enter into the market at $20, and then within 2 days the price is back touching down beneath $7. Well, that's a very different story. That's a very different experience for you. Okay, and this was a story that was particularly sort of seen time and time again, and we had effectively the same with BlackBerry. Okay, BlackBerry. I'm sure there are people who still use them. They're very big 15 years ago, but you can see once for yourself. Okay, that the share price was really sort of just really bouncing around between about sort of $2 and $6 for a long time, not really doing anywhere until we get into 2021, into January, and you can see for yourself, okay, how price had sort of accelerated away from sort of $8, okay, all the way up to north of $28, but within a couple of days, all right, was back down at $14. So having been up to 28, it's almost like halved in 2 days, and back down to 14. Okay, so once again, as I say, if you're in front of this, then effectively, it worked very well. If you were not, well, then invariably it was quite a painful experience, depending upon where your actual overall average price was. So, all of that kind of frenzy, all of that kind of activity, it generates more activity. Again, we live in a world of style over substance. Okay, we live in a world where invariably it is effectively it's about collecting, sort of likes. The major currency is likes on social media, and so invariably, this attracted lots of attention from the media, from all ranges of it. Okay, both on all sorts of sides of the trading equation. So what we actually wanted to see, or what the kind of let's say the kind of the memes, the sort of the media, the kind of interest was showing that demonstrating about how Wall Street bets were now a shark, okay, that was trying to eat the hedge funds who normally eat the kind of smaller retail traders. And that was the kind of image that was, that they kind of liked to portray, that it was effectively, as I said, the Wall Street bets, the guys and girls trading those, it was occasionally affecting them, trying to, the David and Goliath striking a blow against Wall Street just for the average guy in the street. And one of the kind of curious elements of it, as I said, was that, that it attracted commentary, okay, and interventions from people within the media. So we had people like Jordan Belfort. He's on the kind of main Sky News. He's on the main news channels talking about the event, talking about what happened, how he felt about it, what he thought about it. We had people like Mark Cuban, okay, who is a hedge fund manager, and he's a well known, and he's a very very vocal, very present, okay, individual in terms of he's seen across a wide range of media streams, and even Elon Musk, okay, was getting involved and making comments about the whole situation. He himself was saying that he was buying into it as well, and and this, as I said, this kind of opens up a whole Pandora's box, really, about what, if any, kind of infractions of of SEC rules were being effectively sort of fractured or broken throughout this whole situation. So invariably, what it might be seen is that under SEC rules, the people trading through Wall Street bets, okay, you're not actually supposed to to get together and collude to buy together. That's actually deemed against the SEC rules. Wall Street bets would say that most hedge funds have been doing that pretty much for years. Is it right that people like Elon Musk, Belfort, Cuban are actually able to go out there and make their own particular comments on whether they're buying, whether they're involved, whether they're engaged, what they think of it? Is that really, is that kind of the behavior, okay, of good, solid, well-functioning markets? Well, that's something that can be discussed, here, later, and forevermore. Okay, it basically it's attracted a huge amount of information, a huge amount of interest, and I think what we're going to see is that this is kind of we've kind of opened a Pandora's box, whereby we will probably see more of this going on in the future, as communications means, okay, allow sort of traders to coalesce, come together, to actually sort of to either to either sort of engage with an asset or an instrument for profit, or particularly for, let's call it sort of, activist reasons, investment activist reasons. So, invariably, whenever things like this happen, you've got to take a look at, well, who are the winners and who are the losers. Well, in terms of, let's start with, who are the winners. Well, not unsurprisingly, Reddit, okay, which is the sort of internet aggregator, the forums that basically Wall Street Bets and a whole host of other trading and non-trading related sort of groups are run through. Well, invariably that gave them immense exposure to their website and what's going on. It's effectively attracted more viewers to their particular website, and included in that is they also managed to acquire an extra $250 million in funding off the back of all that exposure. One of the other winners, and this might be a bit of a strange one, is that actually quite a few hedge funds were big winners from that. Okay, as I said, although the story is kind of portrayed as this kind of David versus Goliath, it wasn't entirely little fish versus big fish. What we had is actually some institutional investors did well. One of them being Michael Burry. So many of you might know him, may even have heard of him, Michael Burry of Scion Capital. If you've kind of watched the movie or read the book, The Big Short, Michael Burry, who was played by Christian Bale, he was one of the main characters in that. And what he did, it came out that actually he had quite a substantial position in GameStop. He had I think about an average buying price of around about $10, and I think he had about sort of 1.7 million shares in them. So invariably, as they rose, all the way through from $10 to 50 to 100 to 200 to 300 to 500, well, then invariably, his position looked fantastic. But of course, we don't know where Mr. Michael Burry got out, whether he got out at the top or whether he is still holding. Okay, so, but nevertheless, he, having bought at 10, he's an average price of 10, he had done well. And there will have been other hedge funds, okay, that will have done well. There will have been other hedge funds that will have traded against the understanding and knowing of Melvin and others who effectively were oversubscribed on the short side, okay, and were looking to take advantage of that. And that's a nature of markets. That's what we see. So certainly the Reddit and hedge funds, and it might be said that certainly quite a few traders will have been fortunate enough to have effectively get in to GameStop at a short price and then ride it up and exit and leave, and will have made a good profit over that week or so, and fair play to them. Okay, fair play to them. If we look at who are the losers, well, one of the big losers will have been Robinhood. Okay, Robinhood, the pandemic, year before pandemic, had been exceptionally good for Robinhood until this experience with GameStop. As I said earlier on, during the pandemic, lots of people lots of less kind of American traders, or just even the American public, cooped up at home. There was no sports on for them to go betting on. So invariably what they were finding with their stimulus checks is that actually lots of them were effectively putting their money into Robinhood and engaging in a bit of trading on the stock market. And that's why we saw some, increased volatility last year. But invariably, that had done really, really well for Robinhood until, and was doing well until effectively Robinhood basically brought in they removed their trading privileges for GameStop, for AMC, for BlackBerry, and for one or two other particular instruments, because suddenly overnight, well, then invariably traders would lose. You'd lose confidence. You'd lose credibility. You'd be worried about the state of Robinhood as your particular conduit to trading in markets. One of the other losers were I'm going to say first time investors. Okay, but what I mean by that is small time and first time investors, people who have never had any engagement with financial markets whatsoever, and invariably, we're just effectively following the crowd, okay, and we're just overwhelmed by their greed and just looking to open a trading account and buy GameStop at whatever price, even because invariably you could see the social media sort of fascination and interest meant that invariably we were seeing prices, expecting prices, people talking about prices rising to to $1,000 for GameStop, etc. So people were happy to get in at whatever price because they didn't know any different, and they thought that their invariably price was just going to go on higher and higher. And invariably what's happened is they will have paid the price for being uneducated about markets. And this is something that we've always talked about here at Admirals, okay, in the Trading Spotlight webinar series, and my colleagues Marcus and Jens are very clear about that as well, is that it is unbelievably important to invest in your education, to basically to learn as much as you can about financial markets and trading. And that's what this Trading Spotlight webinar series was all about, was effectively about being able to help educate you, to give you the best opportunity to survive, to acquire, and then prosper within financial markets. So invariably, those, as I say, small time, first time, who have no education whatsoever, and were effectively overwhelmed by greed and trying to chase money, and got filled at $300, $320, $400 on GameStop, and then only to see price collapse to beneath 50, well, then invariably that they will have been some of the particular losers on that. And so there's a question of what can we learn from this? Okay, what actually can we there is what can we learn from this? Well, Sergey's just I think Sergey's just said there is no less until you sell, okay, until you release, and that is true, okay, and that is true, but Sergey, that leads to something called loss aversion bias, okay, which we'll touch on a little bit in a moment, okay. But in terms of what we can learn from it, and I said this is just about topics and lessons that all traders can learn from, is that firstly, be careful what you wish for. All right, lots of people love for volatility in markets, okay, and they're always claiming that they want to see volatility markets, all right. But volatility is a double-edged sword, okay? As I said earlier, when you're on the right side of it, well, it's like the wind in your sails, okay, that will take you on your trading journey to great places. But if it's not on your side, okay, if it's against you, well, then invariably, you're likely to get crashed upon the rocks. So be very careful, okay? When people say they want to see more volatility in the market, that is just it's a glib phrase, okay, that can mean anything to anybody, okay? It's about understanding really the kind of what volatility is like, and it's a little bit like a Goldilocks, okay? Too hot or too cold, okay? Is it just right? But then volatility is not something that you or I or anybody can really control. It's about actually being able to understand how that sort of plays out in markets, and also just looking at those charts and recognizing that invariably sometimes that volatility will be out of control. And my view always is to traders is when it gets like that, the best thing is actually for you to sit on the sidelines, okay? Especially if you're a new trader, a new investor. There's no need to try and be a hero, okay? It's about being smart, all right? You're here to be a good trader and to do well, not to sort of have a particular ego. That links into also always have a plan. You want to talk about having a kind of a business plan for your trading business, but also a tactical plan, okay, for your week, for your day, for that particular session, for that particular play. The reason that's important is that when you have a plan, you are much less likely, okay, to fall foul of impulsive decisions, knee-jerk decisions based on greed, based on seeing a market shooting up where you actually just are impulsive, feel a need to sort of hit the bid and stuff and buy the particular instrument. Wherever you're getting your trade, and before you get into trade, always know where your exit is, okay? You always want to know where your exit is, okay? You want to know where your exit is for you to get out if the trade idea doesn't work and you're wrong, but equally have an idea of where you want to get out, okay, in terms of when the trade does work for you, and actually you want to actually sort of look to be able to exit your trade. So lots of people talk about entries, but actually what is equally, and it might be said even more important, is always know where your exit is when you come to a trade plan, okay? Always know where your exit is. Another thing I can tell you, okay, is that chasing the money rarely works. It's very easy to do, okay? You're human, all right? We're all part of that human condition, okay? None of us are perfect. You start to see news getting exciting, okay, about a particular instrument. You start to look at the chart, and it's starting to look like it's going to the moon. It's very easy for kind of, let's say, those new uneducated traders and investors to effectively just feel like they need to chase the money. They have that FOMO, they have that fear of missing out. They don't want the FOMO, so basically they just look, and they'll just hit. And that's what happened. That's what people did. And as I said, they got filled at $300, $400, okay? And then the price was absolutely collapsed. And they didn't have an exit plan, which was the point we've just talked about there. Most importantly is that you can only trade and invest with money that you can afford to lose, okay? And what we should stress, and we stress this all the time here, we're at Admirals, is that invariably, risk management is unbelievably key, okay? And part of that is about only trading and investing with money that you can afford to lose. And as I say there, always, and I do mean always, exercise risk management, okay? That links into, only trading, investing with money you can afford, only sort of, risking a small portion of your account on any one particular trade idea, ensuring that you have a stop loss, which is, your exit should the trade not work out. There is no replacement for doing the hard work yourself. Do your own research. So it becomes very, how shall I describe it? It becomes very attractive to people to effectively to want to ride on the coattails of others. They think that they're being smart and sharp by letting other people do the work, and that they effectively just follow and just buy what everybody else is buying. That kind of herd mentality, and that herd mentality is, is pretty much ingrained within us, okay, back from being the cavemen. And so people think they're smart because they think that, because as I said earlier, we have so much technology, so much media, so much information that it basically prevents people, or it stops people from having to do the hard work themselves, okay. I'm here to tell you that there is no replacement for doing the hard work yourself, okay? Even if there is a huge frenzy and media frenzy on a particular instrument or asset class, it does not stop you from doing the hard work to do your own research yourself, okay? It is a smart way. That way you can make your decisions and focus on your decisions, okay, regardless of the outcome of your particular trades. And if the decision didn't go your way, well, then you can actually debrief and understand why that decision didn't go your way. You can learn from it. Whereas, when people try to follow others, okay, well, invariably what we find is that, part of that is about them wanting to abdicate personal responsibility. That, if a trade goes wrong, well, they have somebody to blame, okay? But we're not here about the blame game. We're here about being good, solid traders. And remember that, trading conditions can change quickly, okay? And literally they can change in the course of a session. They can change a day. That can be simply that, the trend you were going in completely reverses and collapses. It could be that the trading conditions change because of, in this particular case, where effectively, those particular equity brokers put a halt on trading activity in that particular instrument. And that can actually happen. That can actually happen to any instrument or places, especially when we see, the increase in algos operating within markets. There are days, we've had them, okay, where, the algos go rogue, okay, and invariably sometimes trading has to just be halted just because they try to work out what's going on with that particular algo in that particular situation. And I'm going to be doing a webinar later on this month about that, so be sure to keep an eye out for it. But remember, those trading conditions can change quickly, and you have to be adept at recognizing when they do, and also having a small plan to basically make sure that you're on top of that. So just before we came on, I just put, where are we now? What happened with GameStop? Okay, I thought we'd just look at that very quickly for the last minute. And what we can see is that, having, as I said, tickled the underneath of $500, well, actually we fell way down, okay, to underneath 50, okay? So, we fell down, which, like Mr. Michael Burry, who bought, lots of them at $10 when price is still at $50, he is still, he's still profitable. But what we have seen, okay, and once again, over the last 10 days, is we've seen another move, okay, another bullish move in GameStop, like the second coming of GameStop, which I'd be the first to admit, has taken me by surprise, okay? I thought that, having seen events like this before many times in my trading career, I thought pumped, dumped, over and done with. But actually, what we're seeing there, and I think Sergey mentioned that we're over $280 today as the market opened at 230. So it's fascinating to watch. Hopefully, you can see that yes, the chart is moving up, but perhaps not as violently as we saw a month or two ago. So certainly for those people who've bought, and what if you look on social media now, if you look on social media, if you look on Twitter, etc. today, there are lots of people who are tweeting that they are now happy because actually GameStop is now back up at their entry price. So they must have been buying at $200, $250, and they've held that for the last 6 weeks again now to do it. And it'll be interesting to see how those people feel, whether they actually step aside, because they've actually had emotional pain, or whether they will now hopefully hold on, hoping that they think that GameStop is going to go to GameStop will go to the moon. And we saw a little bit the same with AMC having, as I said, got up to $20. We collapsed all the way back down to just above $5.50. But once again, we're starting to drift north. We're drifting north, and it's definitely something we want to have a look at to keep an eye on. I think this might actually be an interesting stock to play. We've got a bit of a gap here. Let me just sort of talk. We have we still have a little bit of a gap here that hasn't filled, and it'd be interesting to see if price drifts up to fill that gap towards $13 over the rest of this particular week. And even BlackBerry has not had the same, let's say, it's not had the same love as GameStop and AMC, but you can see it's collapsed down, and over the last day or two it's just starting to pop up above $10 there. It's just starting to get up above it, and really you want to see, does it have what it takes to get up and hold above it? And once again, if you've been buying back down here at sort of $4 and $5, BlackBerry being at $10, if you're a longer term investor, well, you'd be very, very happy with that. But equally, as you can see, there was that huge volatility there, which will have shaken out an awful lot of people and players. So in conclusion, ladies and gentlemen, the Reddit-driven craze of trading in GME and other stocks, it has been one of the major trading events of 2021 so far. In another version of David versus Goliath, small retail traders decided to get together to attack overextended hedge fund positions in certain stocks, and in particular GameStop. This led to a few crazy trading days where hedge funds were required to cover their shorts, and it caused them significant damage. This had a knock-on effect against some of the major brokers, including those like Robinhood. After price rose dramatically, it also fell away swiftly. With all of these events, there are always winners and losers, and there are always lessons that we can learn from such events. So, if you want to learn more about trading or want to understand more, well, by all means, we appreciate you'd like some support, but come and join us in the Trading Spotlight community. You can find us there, tradersyard.com/group/312. I'm going to be there for the rest of the day. If you have any particular questions about this webinar or any particular trading there, I'm there to actually help and answer any of the questions that you may have. And don't forget to join us next time. If you join my colleague Jens on Friday, he's going to talk about the best technique to avoid negative emotions in your trades, including managing emotions in trading, a list of cognitive biases, and emotion-based retail trading results. So that's going to be 2 o'clock London time, Friday the 12th of March. Check your inbox for the webinar link, or head over to the Admirals Markets website, where you'll find it under the Education tab. I hope you found that useful. I hope you found that an interesting insight. If you have particular questions for us, well, you can always get in touch with us by email, global@admiralmarkets.com, youtube.com/Admiral Markets, where you'll find a huge archive of fantastic resource, and also on facebook.com/Admiral Markets Global. So, ladies and gentlemen, I hope you found that useful. I hope it's given you a little bit of insight into what actually occurred, but also who were the winners and losers, and also what kind of lessons could we learn from it? Because I believe these experiences will happen more, just because of the nature of the working environment they're in, the way they operate, and also just the ability to sort of facilitate large communications between large groups of people who will coalesce to basically achieve their trading aims. As always, okay, I wish you the very best of success in your own trading, and I look forward to speaking to you next week on the next of my Admirals webinars. If you've enjoyed this, if it's helped you, please give us a like. Make sure you subscribe to our channel, and as always, if you've got a question or a comment, please stick it in there, okay, and we'll be very happy to answer your thoughts and questions. And as always, have a great trading week, and I'll speak to you soon.